Hello everyone and welcome to the Quantpedia Explains Trading Strategies video series. Today we will discuss Improving Sector ETF Trading.
Hello everyone, my name is Radovan Vojtko, I'm CEO and Head of Research at Quantpedia. Today we will discuss a special kind of the strategy. It's called the sector picking strategy or sector momentum strategy. This type of the strategy tries to identify which equity sectors in one country, usually it's United States, would outperform in the future. Though most often the momentum signal or momentum predictor is used for this kind of the strategies. We have few of them in our database and take a look at sector momentum rotational system in our database when there is simple explanation how the strategy will look like, or you can take a look industry momentum, riding industry bubbles strategy in our database. Both of them are freely available. We have plus or minus 20 strategies that are related to sector picking keyword. What is our current video about is to how to improve the ETF sector momentum. The problem with ETF sector momentum is that it worked very well in the past, but in the last 5 to 10 years, it has diminishing returns, especially alpha. So when you use the sector momentum strategy that goes long a subset of the sectors and then goes short another subset of the sectors, has zero alpha at all. We already discussed this kind of the problem in another article. It's called Robustness Testing of Country and Asset ETF Momentum Strategies. The problem is that the equity market, especially because there are a lot of ETFs, etc., so it's more efficient, and all of those strategies that worked well in the past not working so well at the moment. So the question is how we can improve the ETF sector momentum. That's this article about. The article is on our blog, and our video is also about this. So what we did, so we downloaded the data for 9 sectors of the S&P 500 index. So those sectors include materials, energy, financials, industrials, technology, consumer staples, utilities, and healthcare, and consumer discretionary. So all of those ETFs, the data are adjusted for dividends and splits. So we use those data. They were sourced from Yahoo Finance, and we had a backtest period from 22nd December 1998 until 5th September 2024. We also used the S&P 500 ETF, SPI ETF, as a benchmark to understand what is the average performance of the equity market, and to make some benchmark that we will try to beat in our sector momentum strategy. So here is the step number 1. So we created benchmark. We have 2 benchmarks, the S&P 500. Here we have performance. We can see that the S&P had a nice performance over the last 26 years, over 7.5%, 50% drawdown Sharpe ratio around 0.49. The second benchmark we created is equally weighted universe of underlying 9 sectors. Equally weighting the sectors has higher performance than just holding the S&P 500. This is usually the reason why there exists equally weighted S&P 500 ETFs, etc. It's not always the best idea to have the market cap weighted benchmark. This benchmark is harder to beat, and that's the reason why we included also the equally weighted benchmark. So those are our benchmarks, and we will try to build a strategy that will beat those benchmarks. Now let's get to a long-short momentum strategy. How does the performance look like? So here we have a long-short momentum. The 12-month momentum. We are ranking all of the ETFs, the sector ETFs, based on past 12-month performance. We select the best 3 and we go long those 3, and we select the worst 3 and we go short those worst 3 ETFs. So it's a market neutral strategy. The holding period is 1 month, and after 1 month we rebalance. Now, as we can see, we have a negative performance, high maximum drawdown, zero alpha. So long-short sector momentum strategy doesn't perform at all. It's not a very good idea to use this strategy. So the question is how we can improve a long-short momentum, and is it really needed to short 100% of the portfolio? So can we somehow improve this long-short momentum? As we will see, it is possible. Firstly, we are not able to simply change or improve the performance just by changing the ranking period from 1 month to 12 months, so try to different ranking periods, or try different number of assets in the long or short side, so 4 versus 4, or 3 versus 3, or 2 versus 2, or 1 versus 1. There are no great differences in performance, so it's not performing very well. The step number 3 was the separation of long and short momentum. We decided to separate the long only leg and short only leg to see what is the contribution. So let's take a look on the long only leg. When we select just the best performing 1, 2, 3, 4, 5, 6 ETFs, what we can see is that as we gradually increase the number of ETFs that we select, our Sharpe ratio increases, our volatility decreases. We gradually have the better Sharpe ratio the more ETFs we select. The optimal number is probably between 4 to 6. Now let's take a look on the short side. So when we take a look on the short side, we are selecting the worst performing, and we are trying to go long those worst performing. And here is the performance. So if we select just one worst performing ETF, our performance is -7%, plus or minus. If we select 2, 3, 4, 5, 6, or etc., we go short those worst performing ETFs, we have performance -10%, which is plus or minus average performance of the market, but with a negative sign. What is like interesting on this table is that if we select only one ETF for short, we have -7% performance. I mean, it's a lot. -7% is not very good performance, but it's significantly better than -10%. And in that moment, we had the spark of inspiration. So what if we use an asymmetrical long-short momentum strategy, which picks the different numbers of assets in the long leg and different number in the short leg? And what if the short leg, I mean the hedging leg, didn't have the same weight as the long leg? I mean, it's not needed to offset 100% of the long performance. We just need to hedge a smaller number. We may hedge just enough and increase the performance of the overall long-short momentum strategy by decreasing the beta exposure of the long leg by hedging with a relatively cheap short leg when we use just one ETF for the shorting. So therefore, the conclusion is that maybe the long-only momentum strategy will be more efficient when we will include 4, 5, or 6 sectors. And for the short-only momentum strategy, we will use the one sector, and we will not use the same weight for the long leg and the short leg. So, and here we have a combination of the momentum and the short strategy in step number 4. So we tried the weights for the short strategy to set between 5% and 30%. So not 100%, but only 5 to 30%. Now, when we are working with this strategy, I mean, it's important when you are shorting to keep in the mind the shorting costs. Our assumption was that approximately a 3-month interest rate is the rate at which we have to pay when we want to short. So that was our shorting rate. Yeah, it can be a little higher, but I mean, as approximation, it's a fine. So we decided to implement the momentum plus short strategy. We used 4, 5, or 6 sectors in the long momentum, and we short one sector. So here we have a performance table. What is important to take a look is the Sharpe ratio and Kalmar ratio. So as we can see, as we gradually increase the number of the shorting leg at around 25 or between 20 and 30% of the short leg, we have a very interesting Sharpe ratio. So Sharpe ratio increased to 0.66 and the Kalmar ratio increased to 0.29 or 0.32. Now let's compare these numbers to long only. As we can see here, we can have long only. So in the long short setting, we have a higher Sharpe ratio and higher Kalmar ratio. And we can compare that to our benchmark, and we have a higher Sharpe ratio and also the higher Kalmar ratio. This higher Sharpe ratio and Kalmar ratio is valid, and it is not important if we have a 4 sectors in the long leg or 5 sectors in the long leg or 6 sectors in the long leg. I mean, 5 sectors are probably the best and have the best Kalmar ratio and Sharpe ratios, but it's not so important how many sectors we will select for the long leg. It's important to short the worst performing ETF, but do not short 100%, but just, I mean, up to 40%, 20, 25, 30%. But nevertheless, there is still a question. So can we improve the strategy? Yeah, we can improve the strategy even more by selectively shorting. We do not need to short all of the time. So we can have a long portfolio, the best 4, 5, 6 sectors equally weighted in the long leg, and we can short only when there is a negative trend on the market. So only when the equally weighted benchmark shows a negative trend, I mean, for example, 12-month moving average. So if the equally weighted benchmark is under its 12-month moving average, we selectively short the worst performing ETF with weight 20, 25, 30%. What are the results? So here we can see the Sharpe ratio increases even more. Kalmar ratio increases even more from 0.41, 42 to 0.37, 39 or 0.40, which is, I mean, very interesting. And Sharpe ratio is plus or minus around 0.7. So that's, I mean, very interesting number. So here is the final strategy, selective long-short momentum strategy, where we use a 5-sector momentum strategy. So each month we go long 5 sectors with the highest 12-month momentum. We selectively short this long portfolio when the equally weighted benchmark is under its moving average by the worst performing ETF, by one worst performing ETF, and short position includes only one sector with the weight of 25%. So this is the final version of the strategy. As we can see, we easily outperform the S&P 500, so we have higher performance, lower standard deviation, significantly lower maximal drawdown, significantly higher Sharpe ratio, significantly higher Kalmar ratio. So I would say that our task is completed. We were able to significantly improve the ETF sector momentum. I mean, you do not need to go short 100% of the portfolio. You can short selectively. You can short, lower weight than, your long leg, because the shorting is about decreasing your beta exposure at the right time, at the right moment. And by decreasing your beta exposure, you can significantly improve your strategy. So refine the strategy, have a Sharpe ratio that reaches values from 0.6 to 0.72. And it outperforms the S&P 500 or equally weighted benchmark over the more than 20 years. So it's a very efficient way how to beat the market. So I hope that you liked this video. I hope that you like the strategy. In case it is so, please give us the like. Please subscribe to our channel. Visit Quantpedia, check our offering, check our articles. And I hope that you will join me in the next video. So thank you very much.
Are you interested? Then pick another video to learn more, or subscribe to Quantpedia Pro and try how our analytics and reporting significantly save time spent on quantitative research.